I was just at a bookstore recently, and this book immediately caught my attention with a really intriguing title. Of course, it's investing related, and it has the book title 100 Beggars. I think this is a very interesting concept because in investing at least, we all talk about wanting to maximize our returns, getting a multi-bagger, 2-bag, 3-bag, 4-bag. Little did we expect that there's another whole body of research and study that is dedicated to find stocks that are gonna go 100x. So let's talk about trying to find the next 100x stock, because putting $1,000 into a stock that 100x will give you 100,000, while putting in $10,000 would give you $1,000,000. So sounds great, right? $10,000 today, in the next foreseeable future, 10, 15, 20 years later, you're gonna get $1,000,000 back. It's a rather easy book to digest. I don't think you really need deep financial or technical skill sets to understand the concepts that the author is trying to put across. And I personally have finished this book in 3 separate sittings in a few hours block. But yeah, it should generally be fine. Particularly so even for those that are in the beginner level. So personally for me, this book is like that song, A Whole New World. Basically, I think it really opens up a different way of thinking, a different mode of looking at this entire investing game. And that's why I'm just going to quickly share my own takeaways from the book itself. I think fundamentally, different investment philosophy all has its own pros and cons. And your job as an investor is really to find one that resonates with you, that fits your personality, and it enables you to be able to stick to that plan and strategy for the long term. So it's a completely different mindset. And for those of you who are generally thinking about your traditional value investing, using a discounted cash flow, doing valuations, buying under intrinsic value, etc. So let's put all those concepts right at the doorstep first, and let's hear what this book has to say in terms of trying to find the next 100-bagger stock. So simply put, there are 10 key essential steps that the author talks about. I think underlying all the different concepts, there's one key principle that you need to take away from this book, and I've probably seen it repeated like at least 5 or 10 times. It's really behind this idea of a twin engine. I'll explain more about the twin engine later because it's part of the 10 key principles. So listing them out, the first principle is actually the idea of mindset. So if you want to find 100-bagger, you need to first have the mindset to want to look for them. If all you have is a hammer, every problem will look like a nail to you. Essentially, this boils back down to mindset. If your mindset is, I'm going to go into the stock market trying to hunt for a good 10-20% return, then you'll definitely engage in activities such as day trading or swing trading, because that's ultimately your goal and your objective. You're trying to find quick profits and flip it for profit and move on to the next idea. On the other hand, if you're looking for a company that really has the potential to 100x from here, there are definitely telltale signs and also prerequisites and criteria that you need to fulfill before finding that particular 100x stock. It's pretty intuitive and common sense, but you need to first alter your mindset before achieving your desired goal. So point number 2 is actually growth, and more growth. So if you're really looking for the next 100-bagger, I dare bet with you in the next 10 to 15 years, in order for your particular investment thesis to play out, this company will probably be at least 5, 10, 20 times bigger than now. And of course, let's not forget that we want to focus on line items such as revenue per share and profits per share. Let's not forget that share dilution has a very real impact to shareholders' returns as well. So on the fundamental level, finding the next 100-bagger would mean that there's a very long runway ahead for them to continuously grow their business. And that's the first part of the twin engine. Having a lot of growth, having a lot of runway, having a lot of potential. The second part of the twin engine is the third essential point, which is having a lower multiple preferred. Firstly, you want to pick a company with a long runway of growth ahead because they're able to grow into the valuation and to give you that 100-bagger. Secondly, you don't want to overpay for the business as well, because if you have to boil it down to the very fundamental principle, actually shareholder returns come from 2 points. Number 1, it's when the earnings of the company grow, and number 2 is when you get a multiple expansion. So think about it. If you buy a particular company at a PE ratio of let's say 3, and it appreciates by 10 times, trading at a 30 times PE ratio, that's where you get your first 10x. The company's earnings actually grow from $1 per share to $10 per share. That's the second 10x. So if you combine these two 10x, that's how you get a 100 bagger. And I think based on the many examples that the book actually provided, doing a post-mortem analysis over the last 50, 100 years, you can see many of these companies actually underwent both of this twin engine. Meaning, number one, they have a very good business model, good business economics, good earnings potential, and good moat that allows them to continuously earn supernormal profits. Number two, that's when the market suddenly realizes its value and you see that multiple expansion. Next, moving on to the fourth principle. Economic moat is a necessity. Not a want, it's a necessity. Because the business will need to have a high return on capital and the ability to reinvest in itself. And if their margins and their investment returns can easily be competed away when new competitors or new entrants come into the industry, and that's when it disrupts the potential compounding the business is able to do based on your shareholders' equity. Webull's in-house platform features help streamline my investment process. So when looking into a new company, some of us might just want a very high level understanding of the basics. So in Webull's native app, you can click into the company section and it will essentially provide you with an overview of the company's past financials, key indicators that you can play around with, and even peer comparisons amongst their competitors. So these numbers and rankings allow me to make the split decision on whether I should look into this company any further. And thus, it has saved me a lot of time when researching into new investment ideas. So their Money Bull campaign has also been extended. So new users can now take advantage of their lowered requirements and you just have to fulfill two key steps. First, tap on participate now and complete an initial funding of any amount during the campaign period. Second, subscribe to Money Bull and maintain the net cumulative deposit amount until the event period, and you'll be able to enjoy cash vouchers worth between 80 to 3,000 US dollars. So it has never been easier. Sign up link will be in the description box down below. Thank you Webull for sponsoring this video. Point number 5 is that a smaller company is preferred. So the author used this quote: start with acorns and wind up with oak trees. Intuitively, let's talk about the two biggest companies in the world today, which is Microsoft and Apple. We all know, or the entire stock market has acknowledged the prowess and the moat of the company, which is why they are trading at a relatively high valuation multiple. And in fact, on an absolute level, both of them are trading at a $3 trillion, give or take, up and down depending on the volatility and the mood of the market. But let's think about it. Is it possible that Microsoft and Apple continue to 100x from here? So 100x meaning that they're going to reach a market cap of $300 trillion. From $3 trillion to $300 trillion. Possible? Yes. Probable? I really don't know. I think intuitively, we can't fathom the idea of looking at a $300 trillion market cap company. I mean, in the long distant future, if Apple and Microsoft continues in their path and they're not disrupted, then because of the sheer idea of inflation, etc., maybe we can see a company slowly break the 10 trillion mark, the 50 trillion mark, the 100 trillion mark. But in order for you to appreciate that in a shorter period of time, maybe in the next 15, 20 years, maybe Apple and Microsoft might not be the most ideal candidate to hit that $100 trillion mark. So in this case, there's really a focus in terms of trying to find smaller companies that are probably in the $2 billion, $5 billion, $10 billion range. And even a $200, $300 billion market cap company, in order for them to 100x, they need to reach a $20 trillion mark. So it's a far cry, not impossible, but simply put, start with acorns and wind up with oak trees. And on point number 6, owner-operator is preferred. Simply put, if the business is run by the founder, there's number 1, skin in the game, and number 2, the founder is probably building a legacy on its own. You want to kind of make sure that the incentive is aligned, and if the founder pretty much has his entire net worth tied to the stock price itself, then you know that incentive is truly aligned. And this is a very timely reminder that no one created a stock so that you can make money. Every stock is available to you because someone else wants to sell it. Point number 7, short and sweet. You need time. So even the fastest 100 baggers, based on the research, probably need at least 5 years. But it will likely take at least 20 to 25 years. So that's when this new concept comes into play, which is the idea behind coffee can portfolio. So the idea of a coffee can is pretty simple. I believe you are probably told of stories before of several elderly people taking coffee cans or taking biscuit cans and just trying to keep money in those tins and cans and hide it under their bed and just ignore for it for 10, 15, 20 until even maybe they pass on. And when their kids grow up and then when they go to their house after they pass away, they realize that, hey, there's this sum of money or pile of money being hidden under the bed. However, I think the concept is similar, but what we keep in the can is different. So we know that if we keep our money in just paper dollars, whether it's the US dollar, the Singapore dollar, those will definitely depreciate in value as inflation bites into your purchasing power. But the idea of keeping a coffee can portfolio is really you identifying a potential stock picks, maybe 5 to 10 names, and just keeping them there and not touching them, not meddling with them, not looking at the price volatility and sell covered call and then buy back in when there's some sort of correction. The idea of coffee can is simple: buy, keep that away, and come back again in 10 years. And that's basically a disciplined approach for you to conserve some level of time in order for these companies to appreciate in value, to achieve that growth in earnings and also that multiple expansion. However, of course, there are many contrasting arguments of whether you want to allow the fruits to ripen on the vines or whether you should pick up earlier, because we do know of many companies that went through a monstrous rally. They can go up 6, 7, 10 times and then it comes back down again to IPO price after 10 years. Of course, I'm not talking about you, Alibaba. But anyhow, it's also never easy to stay vested in a company because there are a lot of ups and downs. And just pick Nvidia as an example. So you know that Nvidia, during the crypto boom, it went up, I think at the peak, it went up to $300-$400. And after the crypto winter and the entire slowdown in the GPU market, Nvidia actually crashed back down to 100 plus again. So 5 and 6x again. I'm trading at closer to 600 today. So you can see that there's huge amount of volatility as Nvidia went up. So there's a lot of contrasting arguments and a lot of contradictions in this space. But as long as you're only focused in picking your 100 baggers, you need to allow time to work its magic. Simple as that. There's no two ways around it. And on point number 8 is that you really need a very good filter. There's a lot of distractions, a lot of temptations along the way. Everybody talking about the next in thing, about this macroeconomic news, about the Fed meeting, about this company doing this acquisition, and how competition is going to destroy the company. And you really need to know how to filter out and differentiate between noise and real impact. And trust me, a lot of things will go wrong, especially if your holding period is in the 15, 20, 25 years range. I'm going to play a short clip about what the CIO of Bailey Guilford actually talked about.
Lots of people say they're long-term investors, but then when you look at their turnover statistics, it doesn't back up that claim. And why? It's because if you're a long-term investor, things go wrong, and forget trying to be clever and buying at the bottom of the dips, but simply enduring through those periods where things are going wrong can be extremely difficult. There have been more than 10 occasions in our ownership of Tesla where the stock price has dipped over 30%. And there's a pressure that comes with that. So it's what things do you look to simply to endure the inevitable dark days that you're going to face.
And on point number 9, it's very simple. Let's not discount the impact of luck. Good luck is extremely necessary for you to appreciate that 100 bagger. And of course, the last point number 10, is that you need to be a very reluctant seller. So there's this very interesting quote from another book that I'm currently reading, which is Common Stocks, Uncommon Profits. If the job is correctly done when a common stock is purchased, the time to sell is almost never. So if you really think about it, all 10 pointers are complementary. You need to have the right mindset. You need to be on the lookout for the right things. You need to look for smaller companies. You need to appreciate lower multiple in terms of your entry. You need to have a huge growth ahead. You need to have operators that have incentives that are aligned to you. You need a lot of time. You need a lot of luck. You need a good filter, and you cannot sell in between. So just a very simple conclusion for me. At least for myself, in my own personal investing journey, I have not experienced a 100 bagger, but the closest that I've gotten is a 1 bagger, meaning it basically doubled, which is Meta Platforms. So specifically for Meta, I really didn't expect it to rebound so quickly in such a short span of time. But that said, Meta is probably not a company that is going to 100x from here, because let's not forget, At the time that I bought in, the valuations were closer to $500 billion. For it to 100x, it needs to reach a $50 trillion market cap. Possible, but it might come when I retire, which is in 40, 50 years' time. But that said, I think one overarching fundamentals for any investing philosophy is really the idea back to mindset. Personally, for me at least, how I conduct my portfolio is that I'm looking for companies that are able to multi-bag, meaning if I have a time horizon of at least 5 to 10 years, I do hope to see the position multiply by at least 3 to 5 times. Or at least that's my target rate or hurdle rate. However, this book really opened my horizon and really understanding it from a different perspective. Because I'm currently limiting my upside by looking at the horizon of companies that are able to 3x or 5x in the following 5-10 years. But if you were to drag it out, and for those of you who have the stomach and tenacity to appreciate the 100 bagger, then this might be up your alley. And it's very true that your mindset and your philosophy limits your progress. So personally, I will be incorporating some of the lessons, but I think I'm still very comfortable playing in my lane. So 100 bagger opportunities, I guess I'll be on the lookout, but it will not constitute my entire portfolio. I hope you enjoyed this discussion and you learned a thing or two from this. With that, I'll see you guys in the next video. Goodbye.